What's going on, brothers? Welcome back to Brotherhood Finance. In today's podcast, we're going to be covering a multitude of aspects. Today, we have special guest Coach King, very intellectual individual. He's going to be covering a multitude of things. He's going to be talking about Roth IRAs, the importance of setting those up. He's going to be talking about life insurance and various other aspects. I appreciate you tuning in to Brotherhood Finance. Before we get started, make sure to leave a like down below. Make sure to leave a comment. We appreciate you stopping by for the podcast, and let's get started. How are we doing today, Cole?
Good. We're doing good. Just an introduction to Coach King. Coach TK is a college lacrosse coach at Flagler College. He has life insurance. He does life insurance for the ages 18 to 70 plus, as well as been in the game since around 2002.
Awesome.
So, yeah, Coach TK, if you want to go into kind of introducing yourself, what you do, and kind of explaining to everybody what you do.
Yeah, thanks, guys. First of all, let me thank you for having me on. I was able to catch up with a couple of your previous podcasts. I really like what you guys are doing with this kind of content, especially to your age group. I think it's really important that that the college students and even people that didn't graduate college, people that go right into the workforce, start getting this kind of information. I know that, crypto, NFTs, meme coins, and all of that have become this popular rage, for how people are going to make money. But there's also the basics of building a foundation, of your financial plan. So what I want to get into a little bit here is some of the topics you guys have already covered, meaning, Roth IRAs and why you would look at one type of investment compared to another. One of the topics that's very overlooked is life insurance. Life insurance is usually a topic that comes up much later in life. It comes up, unfortunately, at the wrong times, when people get diagnosed maybe with something at any age that can be, change their lives. And then you've got life insurance that 50 and 60-year-old really looking as to be just for covering some of their mortgage, things like that, but also as a generational estate planning tool. When you start early and when you get these basics into your plan when you're in your 20s, it makes a huge difference. Myself being 53 and then being in the working world for quite some time, I know there's a lot of I wishes that come up. They come up for what I do 20s, I do, all stuff. I think one of that attracted some of our conversation that Cole and I were talking about earlier was when I was your age, I was the same kind of go-getter, wanting to get involved in finance, wanting to go learn how to really make it. Obviously everybody thinks of the word make it rich. Money is very relative, and making it rich can be seen in a lot of different ways. So you don't have to be a guy that's buying a Lambo and that kind of thing, to be rich. And creating your foundation of your plan, especially if that plan has to do with you maybe being an earner that's in the $30,000-$40,000 range in first parts of your professional career. You might step up to 80 or 100,000. But our government gives us tools for all the different economic classes. I think that right there is a pretty good topic, even for you guys, just in terms of the information you're giving out. But when you take those tools that the government's giving, you obviously have the less fortunate that have a lot of tools on how to get food, how to, things like that. And then for the middle class, you have different tools that have to do with tax benefits. Roth IRA being one of them. There is sort of a tax shelter that you can have with life insurance where they cap it, and they cap you at income level for investing in Roth. They cap you at how much you can invest in Roth. They cap you in life insurance in what's called a MEC, modified endowment, and that caps you from how much money can I invest into life insurance and avoid taxes. So when they're putting those caps on those things, they must be beneficial to what you're doing, as a young man, to create the base of your financial plan. So with that being said, if you guys want to rebound any questions, I can go over some of the basics about life insurance, and then why I would like to steer you guys towards a certain type of life insurance that is a little bit more complicated, but it helps to create that base, as a young man. Anything you guys have as I'm going to elaborate?
Yeah, so kind of, I guess one of the first questions regarding to, life insurance first is, I guess, a lot of people nowadays, you see on TikTok, you see Instagram, YouTube, etc. A lot of things is, invest in, stock market, invest in cryptocurrency, invest in, real estate, X, Y, and Z. What makes life insurance so different from those other asset classes?
Yeah. So first of all, the tool of life insurance and the term insurance is basically a fallback plan for a hazard or something major that happens. And to be insured means that you're paying in on a monthly or annual basis with a large group of people to cover that catastrophe or cover that thing that may happen. So life insurance can be used just purely as insurance. And then when we talk about like the topics that you're bringing up, where you're talking about investments, savings plan, you're talking about more risk-oriented type of investments. I mean, I was going to say gambles, but it's not. I don't think it's fair to say the gamble word there. It's like, you get a strategic plan on how you're investing. Some of it has more risk and some of it has less risk. So insurance and your Roth are two of the plans that have much less risk, and you can learn how to calculate that risk by using the life insurance tool. So I want to say that life insurance is an investment in yourself. It's almost like, you get taxes. If you're a W-2 employee, you get taxes taken out of your check before you ever even get that money. There's a lot of tax strategies you can have for, pushing that back and maybe not giving the money to the government right away and then paying it at the end of the year. But life insurance has a strategy where you're basically paying taxes to yourself and you're creating your own savings plan. And I'm getting a little bit more into the specific type of life insurance that I'm talking about. But why don't I just keep rolling here and give you a couple of the basics of what life insurance is. So for those of you that are not familiar, the term life insurance is kind of the most popular way that some look at insurance. Your employer sometimes offers you, you can buy it yourself. There is a major difference in owning your own life insurance policy compared to taking the one that your business or company do, or you pay into through them, because when the job goes, the insurance goes. Some of them let you buy into it later, say when you leave the job, but at that point you're talking about a more expensive endeavor to keep that insurance. So term insurance is basically a contract or an agreement that says you're going to pay a certain amount monthly, which is usually a small amount, and you're going to insure yourself to a much larger amount. Let's just give you some figures here. Say about $25 to $50 a month could get you somewhere between $100,000 or $500,000 in insurance. Now, this all comes at you passing away, but you would have a beneficiary that is the reason that you wanted to get that insurance, of who you're helping out, or maybe taking care of your wife. You don't even have to be married, say a girlfriend, your parents. If you get to the age where you're having children, you could be covering them and their expenses. You could have a mortgage on a house. Mortgage protection is just kind of a term for why you would get insurance, to pay a small monthly amount to cover that big monthly, that large overall bill if you're going to pay the house free and clear. So term insurance contract that has the most amount of coverage, and it ends when you stop paying. So if you get a 30-year policy, you could stop paying after 5 years, and then it's just the contract is done. You don't owe any more money. It's not like a debt where you have to keep paying. You just pay for as long as you want the coverage. And then the coverage has a contract term, which could be 10 years, 20 years, 30 years, that it ends or expires at the end of that contract term based on what the insurance company has agreed to. So that's a term insurance policy plan. A whole life policy is similar to term, except for it can last your whole life. So it's a little bit different in qualifying. It's a little bit more expensive on the monthly payment, but it doesn't have an exact term where it ends. You have the option to keep paying into it for your whole life. And then in some of those whole life plans, there's actually a cash value that builds up based on how much premium you've put in over a certain period of time, and do you want to cancel that policy and terminate it and then get a cash value back for that money? So you sort of invested in yourself in that way. And then the third one, which is the one I really want to give you guys information on, is called an Index Universal Life Policy. Universal life, meaning universal, the most flexibility. It gives you a lot of options in your insurance plan as you're paying for it. Index, meaning where is your money going when it's invested? There's also a VUL, which is a variable universal life insurance. The variable one, though, is a pure stock-related investment. You can actually lose your money in a variable policy because you can go down. It obviously can go up if you have it invested in the right investments. The one that I like the best is the Index Universal Life Policy, because when you're invested in the indice or the index that the insurance company is giving you, you have a zero floor. You're not going to go down ever with the premiums that you're putting in, but the money's invested for you, and the life insurance policy or insurer is taking the risk on that money. So essentially, you're kind of sharing the money as the money's invested for yourself. And let's just say there's a range of 4 to 7% that you could have on a return with an index policy. The insurance company kind of balances themselves out to give you that 4 to 7%, even if it went like, let's say 12 or 18 in one given year, so that later on, if it starts going lower, they can still try to average you out to that 4 to 7%. And then if it completely tanks, then it can go down to zero, but it has a zero floor. Awesome. Some of the benefits of an Index Universal Life Policy by investing in yourself in this way gives you this tax shelter that I'm talking about. So if you invest in putting a premium in every month, let's say $100, and I'm going to use kind of real figures for a type of policy that a 25-year-old or a little bit younger, a little bit older can qualify for. And they would pay around $100 investing in themselves sort of as a savings plan. You would get about $300,000 of coverage as a death benefit to go to your beneficiary. And as you pay in every month, that gets invested into that index and can grow. The amount of growth you have is never taxed for you unless you pull the money out. So if you cancel the policy and you take all the money back, you're going to owe taxes on the difference between your premium of what you put in, which is also post-tax dollars. So you're not putting in pre-tax dollars. You're putting in money you earned and you already paid taxes on it. And then the difference of what it earned, you would owe taxes on that money. Now, where the shelter comes in, and they're starting to talk about this in crypto, the way that they have these derivatives, or you can take money from it. And what's his name? Michael Saylor, I think, was talking big about this. You borrow against it instead of taking it, instead of selling it, or taking, in the insurance world, taking the policy back. At that point, you're getting that money without having to pay taxes on it. Now, the way it balances out for an index life insurance policy is then it goes to where the beneficiary, how much they get at the end if you should pass away. But in the meantime, you've worked your plan. You've worked your tax shelter plan. You've got money that is now you're able to use. So you start at, say, 25 years old, you get to be 35 or 45. You start having some, maybe you want to buy a house. Maybe you're looking at college for your kid. Whatever it is that you need the money for, you borrow against it, pay no taxes. And that's one of the biggest things I think that is overlooked by majority of people on why you would use a life insurance policy. And crypto, I think, is kind of bringing this to light. And I really do believe the way the market's going is that you're going to start being able to get all of these different types of financial investments or policies through crypto. And I think that all of the different ecosystems will eventually find their way to be able to offer these services like this in the life insurance industry.
100%. Yeah, Coach King, you elaborate on, a lot of things. So if you guys need to go back and watch that, he just spit a lot of words of wisdom and knowledge that really is imperative. I know a lot of our audience is mainly, in their 20s or in their 30s, but we'll make sure to leave his information down below if you want to check that out. As again, he has a multitude of experience in the industry, and I'm sure he can help you a lot. Now, you may be asking yourself, why should I get in life insurance? Why should I get in a Roth IRA? And it goes back to what he mentioned. Time can be your best asset, or it could be your worst asset. And it's imperative to really grasp these skills and concepts right now. That way you can implement them at a younger age. Get life insurance, get in a Roth IRA. And, that's how you can really use compound interest to your advantage and, set yourself up for financial freedom. And really, that is the main goal. And with life insurance, you may be able to get better deals at a young age. And, you never know when you may need that life insurance. There's always unexpected events that can occur and things that can happen in your lives where life insurance can really come in handy and save you. So, Coach King, I really appreciate you elaborating on all that information. And if you guys need to go back and rewatch it, make sure you do. He spit a lot of knowledge, a lot of things to really intake. But yeah, I agree 100% that life insurance is definitely imperative. There's a lot of benefits to it. There's a tax shelter, much like a Roth IRA, and they limit it that way because they don't want you to get all those benefits. They want to limit you because the government knows, as Coach TK stated, that they only want you to get so much benefits out of it, much like a Roth, where you can only put $6,000 in a year and it's pre-tax. So yeah, I appreciate you covering that. And yeah, 100%.
Yeah, one thing you brought up, Brendan, is that to qualify for a life insurance policy, it's not based on your financials, which is what a lot of people wait for to buy a house or even become an accredited investor, which is becoming a really big topic nowadays with this crypto stuff. But your life insurance policy is based on your age and your medical history. So the earlier you get it, the better the policy is going to be. And then once you have it, it never changes. So as long as you are paying into it, using that tool, you don't have to requalify at any other given time. So I think that's a really good point that you just brought up.
Awesome. Yeah. Cole, you have any questions for the next one?
Yeah. So I guess, as you talked about the different types of life insurance. You talked about the index universal life insurance policy. And I kind of want to dive a little bit more into that because, especially, as a 20-year-old and, people that, like the majority of our audience are 20, 30, I think you should go over one more time, kind of explain the benefit of the life universal life index, how Brendan referred to, you can use the compound interest to basically build wealth over time. What does, if for an example, if I wanted to put in $100, $200 a month, what kind of return on investment can I look at, or, what kind of, return, I guess, am I looking at, when I do get to the certain age, I want to, either pull it out or, keep it going, or however may I choose to do that. So.
Yeah, great question. So one of the things that happens with your application for an index universal life policy is we provide you with what's called an illustration. The illustration will break down what you're paying in the premium on a monthly basis or annual basis, and then how much growth you'll see based on a 10-year history and a 100-year history of what's happened in these indexes. There, you've got the regular Standards and Poor's and that sort of thing, but some of these life insurance companies have their own index. So they're invested in a certain amount of things that they believe in, and they kind of even it out through that index. So you have those, and the illustration is what gives you that. Now, I'll give you kind of a rough example. One of the things that I think there's a new type of policy that has been put out there with Mutual of Omaha, and they have what's called a simplified issue policy, which means you don't have to get the medical exam where someone's not coming to your house, you're not going to a clinic, swabbing your mouth or taking blood or any of that. It's basically an over the phone or in-person interview, and you do the application online. They look up your health history with a MIB report, and you either qualify or don't. So some of the numbers with that is about $100 a month would get you $300,000 of a policy, which then creates your own estate. Now you, without saving money, you're now worth $300,000. And you're paying $100 a month to be worth that $300,000. So there's actually no better return on investment, I don't believe, in terms of how much you put in and how much you can get back. But really, a life insurance policy is more for what you're protecting than it is for yourself, for your own money. Now, once you've paid into your premiums for 5 years, 10 years, 15 years, that illustration would give you an exact amount based on past history of how it's performed. So just a good idea, let's say you had $100 premium and you went in for about 10 years. I would say as a guesstimate, you come around 20 grand, something like that, by the time you are looking to either borrow against it or cash it out. In my opinion, I think that using it as for your whole life is really the best way to do this sort of policy, because you can borrow the money against what you put in, and then you can pay it back and invest right back in. There's actually two schools of thought with insurance. One is to pay the least amount of money for the most amount of coverage. The other is get the least amount of coverage for the most amount of premium, because that way you're pushing the envelope of that savings plan as far as you can without going into that MEC, modified endowment contract. What happens with a MEC is that then all of a sudden it becomes taxable. So that's the only difference of what a MEC does to your policy, is it makes it a taxable event. So as long as you stay within those numbers of what the government is restricting you on it, you have a savings plan that, again, can earn interest and or have gains based on a percent of interest, and you can borrow against it, and the only thing that affects later is what the overall death benefit is later. And if you have a $300,000 death benefit policy and you borrowed, say, $20,000 off of it, you're really not affecting that much what the beneficiary is going to receive, because $280,000 instead of $100,000. And this type of policy grows with you. So rather than having a policy where when you're 25, you need, let's say, $200,000 of coverage for the least amount of premium in a term policy, all right, I want that to last for 10 or 20 years. Every 10 years, when you get to be 30 or you get to be 40 or you get to 50, you can change what you want as the premium amount, so how much you're investing. You can change how much you want the death benefit to be. That's where that universal word comes in. It's universal because you can cater the terms of it at the different times of your life, and you can change who the beneficiary is to whatever is the most important thing at that time. At first it might be, like I said, it might be just your parents. You're helping your parents based on just burial or anything else that is needed. Then you have a girlfriend or a fiance and you're protecting her. Then you get married and then you have kids, and then your kids turn 18 and now you want them to be the beneficiary, which, by the way, the purest form of passing money to the next generation is through an insurance policy. It doesn't go to probate. It settles right away. It's the least complicated way to pass money on to the next generation.
Yeah, 100%. I mean, and Coach King, again, you elaborate on a lot of important things, and some of the benefits that you mentioned were, you have that death policy for family members, and some that's very imperative that you mentioned also that, a lot of people need to, elaborate on is you can borrow against asset vehicles, and especially life insurance. That's something that when you study the rich and stuff like that, they borrow against the assets. That way, they're not losing, their capital because they know liquidity is imperative, but they're able to, buy different assets with, their war chest that they built and all those other things. So that's also something to keep in mind. Like you said, they earn competitive rates. You have that death benefit. You can borrow against them. And something that's also super important is, you're able to get a lower and lock in a lower premium, as Coach TK mentioned, when you're younger and you're a young age. That's why it's so imperative that if you're young, you may be asking yourself, why should I do this? It's because not only do you get all those benefits that Coach TK mentioned, but you also will be able to lock in a higher premium amount, $200,000, $300,000, and your payments may be lower and you're younger because, as he said, it goes off your health and a lot of other things. But typically when you're younger, you're going to be able to lock in a better deal. So that's definitely important to keep in mind. And, these are very important things that he's covering. And life insurance, it may be something you think you need to think down the road, but it's actually better off for you to get started at a young age so you can get all those benefits that he just mentioned.
And like Brendan always elaborates on, not only that, but when you're investing, through a Roth IRA, what we talk about all the time, someone's going to have a bigger benefit if they start at 20 years old than if they start at 30 years old. So, it's just, again, the compound effect, the way that money can work for you and you not have to work as hard for it. So I think, life insurance is a great way and a great policy that people can go through to not only, build wealth for their future generations, but as well as for themselves, and to be able to leverage it, be able to use that money if need so. Kind of going into that, I know Coach TK elaborated on, cryptocurrency and how, life insurance is, kind of evolving, especially with, how the people need to have to save properly, or, the new technology that they're coming out with. Coach TK, is there anything that you've noticed regarding, I guess, crypto or anything on like Web 3.0 or things like that are affecting life insurance or stuff like that?
Well, a couple things. I wanted to just bring up one point. There's a term that's used now a lot with crypto called dollar cost averaging, right? So if you look at a premium of a life insurance policy, or you look at like a small investment to your Roth, if you just put $100 a month towards your life insurance policy, $100 a month towards your Roth, and Roth, you can go up to, what is it, 6,000 or 7,000, I think, in a year now, if you make less than $144,000 a year. So if you view it in that way, like your dollar cost averaging into those two investments, I think that's a really good way, to look at it. Secondly, with your question about crypto, in my opinion, there's a major shift that's happening. This is larger than what our parents and our parents' parents have seen over the last 100 years. Life insurance companies are the most solvent investors that there is out there. They have to back their money in a way more than banks even do that loan you money for your mortgage or whatever, any kind of loans or what they even have in the bank, right? life insurance companies have been held to such a standard that they are one of the most solvent businesses out there. So one of the things that you bring up about crypto, and as you're invested in a life insurance policy, let's say, you're kind of invested in it with that life insurance company. And the first, I think, group that is going to make sure that they're staying with the times of crypto and what they're invested in is going to be these life insurance companies. I mean, if they have dollars, US dollars, or whatever else they're invested in, they're going to move it when the larger, like right now we have all mostly retail that's invested in crypto. And we're waiting for the institutions, and we're waiting for the larger markets to come in. Well, that's one of those larger markets, the life insurance agencies, and they are very, very solvent and have a ton of money. So I do think, I don't think that it's any time like in the next month or in, I don't know how to say soon, but they will move with the times on that back end and make sure that they're safe. So that they have money. So I think that's one thing that I believe that's happening in crypto that we will see with these life insurance companies. And I also do believe that as we change to Web 3.0 and these smart contracts are able to be used, you're going to see insurance policies that are written into a smart contract or say purchased at the NFT, so that it has an exact contract to it that pays out where it's trustless. You don't have to worry about whether or not a company, how solvent a company is, let's say. It's already in those things. And I don't think we have anything like that now. But I do think those things are coming.
Yeah, 100%.
Yeah.
Go ahead, Cole.
No, you're good. Go ahead.
Yeah. So, just to touch on that, and, Coach King mentioned something that, I agree with 100%. We talk about that at Brotherhood Finance is crypto is completely evolutionizing the whole financial industry itself. And we're seeing that, in the life insurance policies, we're seeing that with banks like BlackRock and other big, large corporations really getting involved and trying to figure it out. And, I tell Cole and I tell our audience here at Brotherhood Finance is I really view cryptocurrency as the internet of the 1980s. Every once in 100 years, and, there's these major events that are really life-changing. And, if you can take advantage of them, there's great returns. And I really believe overall that's the cryptocurrency industry, as we're seeing it evolutionize, again, the way the financial industry is operating, such as faster transaction speeds, being able to send money across the world, to people, and, just a lot of those things that we've mentioned. And, with them printing a lot of money, that's why it's important to get into life insurance policies, to, invest your money in the right asset vehicles, to get into cryptocurrency, and, stuff like that. This isn't financial advice, but this is financial education. And that's why we bring on very imperative people like Coach TK right here. So he can really, inform you about, the positive aspects of life insurance, how cryptocurrency is getting into the industry, why time is your best asset, and, a lot of these other things that we've mentioned. So I agree 100% overall. And cryptocurrency is definitely, a topic that I believe overall will continue to grow and grow. And as more corporations get involved, more financial institutions, life insurance companies, it's only going to have that compound effect, much like how, investing in your 20s has that major compound effect for a Roth IRA and for a life insurance policy, as you mentioned.
And Brendan, what you mentioned there, I think that the older generation, my age, 50 years old plus, are not as apt to like change. We have kind of a perfect storm that's happening here, that not only is crypto a new technology, but it also is a change for the whole legacy financial system that's throughout the world. Those two things combined is why there's such a major change happening. I think that the younger audience that you guys have, and that's why I'm so honored to be on here talking with you guys, you guys might be leapfrogging that older generation with how smart you get with how you're investing and being into some stuff early, like you said about being in in the internet back in the 90s, and the technology changes have made the wealth happen throughout history. And most of it has to do with either travel or communication. And you can go back to your books in high school and read about, the Great Railroad and just that travel was the difference in industry, in major industry. So communication is the other major industry breaker or disruptor. And I think that this technology almost encompasses all of it in one technology.
Yeah, 100%.
Yeah, so I think elaborating on that a little bit, it's crazy to see the evolution of, cryptocurrency. If you even look back at 2012 when people were mining Bitcoin, you since then we have had thousands of different cryptocurrencies be, evolved, whether, people are referring to meme coins, altcoins, you have, cryptocurrencies that have special niches attached to them, like technology, like different things, almost kind of related to a stock. You have some cryptocurrencies that do different things that, have benefits. And then you have cryptos that are actual legitimate assets that have limited supplies, especially like Bitcoin. It's really, I think cryptocurrency has created more millionaires than almost any asset vehicle ever. So just to see the evolution of cryptocurrency is remarkable, because there's not a different asset vehicle that you can put in $10,000 and get the return on investment like cryptocurrency. If especially with, Coach TK being in real estate in his early years, especially if you're an investor in a multifamily unit, you only get a certain percentage of that back, your NOI, especially after, your expenses and everything like that. What Coach TK is referring to when he's saying is leverage, I'll put in an example for people who don't understand. Leveraging is borrowing money off a given asset. For an example, if it was real estate, I would be leveraging 70, 80% of that money. So when I put a down payment on $1 million complex, I'm only putting down $200,000. And I'm leveraging that 80% and I'm paying it back over time, as where I put down all my money. And now I'm in a predicament where I'm not earning any money, no passive income for the next, 5 or so years until that given asset is paid off. So I think that was we should definitely elaborate on that, especially for people who don't know. And once again, I really think cryptocurrency is, right now, obviously we've seen it's taken, a little bit of a dip, but as we know, in any market system, the market always corrects itself. I think this is just the beginning for cryptocurrency, especially that only 14% of the world has cryptocurrency in their portfolio. So that's definitely something, that we can just see even alone if we're referring it back to the internet in the 1980s, how many people really were on the internet then compared to now. So yeah. If we watch the evolution, and as history repeats itself. And I think this is just the beginning for crypto. This is just the beginning for NFTs. And I think it's on, it refers back to life insurance and, how important it is to use that compound effect.
Cole, I give you something to think about that might kind of blow the mind of some of your audience. Okay. Back when I got into real estate, right now we're talking about hyperinflation, rates going up, and all these things are going to destroy the world and all this kind of stuff. When I got into real estate and was buying my first houses, I was paying upwards of 9% on the interest rate and 2 points up front just to get the deal done. The loan to values were all up there in the 95, 97% range. This whole country actually is basically our financial system is built on debt. And yep. If you can leverage an asset in order to then get passive income, and I know right now, there's a lot of hot topics in real estate, but think about this: you invest in crypto now, and it turns into an asset that is worth the same as a 10-story complex that's down in Miami, and all you have to do for life is to borrow against it. That's it. You don't have to pay taxes on it. You don't have to do maintenance on it. You don't have to do any of those things. And right now, you created your own asset to borrow against. And one of the single best things right now for a person to have as an asset, and this sounds wrong, is to have debt that someone else is paying back for you. So when you can create debt for yourself and take that risk, but then manage it properly so that someone else is paying it back, you're earning every time the payment is made. It's two vehicles that are, I think, a crucial way of looking at the statement you just said, Cole.
Yeah, and I think it's very important that we, really honestly go into that route of why debt is important. You hear all the time, I especially, not only my family, families around me that say that they've been taught, get out of debt. They've been taught, make sure you make your payments on time, do this, that, and the third. But honestly, as Brennan will tell you in a second, we preach all the time, use debt, use debt, use debt. Because why use our money when the government can, hand out trillions of dollars in a snap of a finger? So it's, for us, it's, and make sure you use that debt. And Brendan can definitely go into detail that we explain people in Brotherhood Finance why to use debt, especially, knowing that, people like Robert Kiyosaki, great investors of all time, explain, his 3 rules.
Yeah, 100%. And just to
Brendan,
dive into that, what Coach TK was saying is he was saying that there's good debt and there's bad debt. And what Robert Kiyosaki teaches is, the rich understand 2 main things. And this is the difference between, the middle class, the rich, and the poor, is they understand debt and taxes. And they understand financial sheets, your income, your expenses, what they're going to, how to take care and manage those things, as you said, because when you have that good debt, such as rental property or borrowing against an asset vehicle to buy an additional asset vehicle, like Cole mentioned, real estate, what do you have? You have cash flow, you have appreciation, you have tax write-offs, you have amortization, and you even have, depreciation if, you can claim that also. So that's something definitely to keep in mind, and, use good debt and compared to bad debt. And that's why also we have videos talking about credit scores, building your credit, a lot of, very imperative things that we covered. And, also to go back real quick, I know, Coach TK mentioned he was talking about inflation, and we are in a very high inflationary period. Just to put this into perspective, when we had that, the recession in 2008, there was $850 that the U.S. government printed to get us out. We have printed almost $6-7 trillion from the coronavirus pandemic, but yet people are still saving money. And that's why Robert Kiyosaki will tell you, savers are losers. The rich invest in assets. The rich use debt. They have multiple flows of income. The average millionaire has 7 streams of income. It's all about having passive income because, going back to those quadrants, you have the employee quadrant, the investor quadrant, the business owner quadrant, and the self-employed. And the business owners pay the least amount of taxes. So that's, also something to elaborate on when you're talking about good debt and bad debt. And not only that, if you have a company or you have, that good debt, a lot of the times you can write off a lot of those things for the tax, advantages that we just mentioned. So, there's a big differentiation. There's definitely a crazy economy we're in right now with them raising interest rates, actually the highest since 2005. So that's something important to keep in mind. We have seen, huge prices in real estate and those asset vehicles, but I think with interest rates going up, that's going to make people, a little more lenient of trying to buy a house, or they're going to need more capital to go downward to buy that, that asset, that real estate, because if not, they're going to be hit with super high interest rates on real estate. And that's, what, as Coach TK mentioned, that's what they're using to control CPI, Consumer Price Index. It came at 7.8%, the highest since 1982. So we're definitely in a very unusual environment right now. And that's why if you watch other content that we preach, what Cole preaches, a lot of knowledge and wisdom that TK is mentioning, you can help prepare yourself for, if there is a crash or how to protect yourself. And one of those ways could be through, life insurance, as he mentioned. And, starting at a young age is very imperative. So I definitely, agree with a lot of the things you're saying. And it's very important to use good debt, have a good credit score, know how to manage your income, know how to manage your expenses. A lot of those things that we preach at Brotherhood Finance, and Coach TK is informing us all today.
Yeah, Brandon, you hit the nail on the head. I was just about to try to say from the podcast you've already had, for you to elaborate on exactly what you just said, because the key is knowing what type of debt you have and whether you need to get out of debt or whether you can use that debt. But just to give you another scenario based on experience here, I had a lot of real estate going into 2008. The regulations, which is right now what we're waiting for on crypto, the regulations changed at that time for mortgage brokers and lending to take away certain loans that stopped the influx of the money to be there to carry your real estate. So there was a lot of people who were making it work in real estate. And I don't want to say that they were all upside down on their mortgages, because some of them were not, but some of them just weren't in a good enough LTV situation, managing a piece of property that had a good enough rent history. And back then, Airbnb didn't exist. And Airbnb helps a lot of things if you have the type of property that can be used for Airbnb. But nobody had thought about that yet back in 2008. So I watched a lot of my money disappear as I couldn't get loans anymore. The mortgage restrictions, because I own a mortgage company, all of that was being restricted all at once. So no matter how you're investing, just realize this: one, it may not last forever. Two, there are regulations that will come into play when something's kind of too good to be true, or even just good. They're gonna regulate it. So there's things that can happen. In my opinion, if you're invested in real estate, you need to have some money in crypto. If you're invested in crypto and you make some money, you need to mitigate it out into some real estate in order to keep a good balance for yourself. Because unlike the US dollar and unlike all the other currencies around the world, crypto is going to go up. Bitcoin is going to go up. These other things are going to go down. And if you are at least going up, not necessarily just with what the currency is, but what the technology use case of the technology, and you had investments, it will protect you later when things are going wrong or regulation comes in that is bad for that. And then if they give us proper regulation now, you'll see this industry really soar. This asset class will become even more for real than it is now. And it's only been about 12 months that the big money people are accepting that this is real and it's coming and they can't stop it.
Yeah, and we teach all the time, how key it is to have diverse portfolios. You never put all your eggs into one basket.
Amen.
That whether that's either cryptocurrency, whether that's real estate, whether it's stock market, whatever it may be. Because you take a look at crypto and the stock market. And if you had all your eggs in one basket in crypto, and you bought in at 40,000 a Bitcoin, and now it's down to 38, 37 right now. You're losing money. So you always got to have, especially, we talk about, especially when you invest in the stock market, you don't want to have one stock that goes up when it's a positive day in the market. You want to have another stock that when it's a negative day in the market, you have something that balances it out. It's all about creating that diverse portfolio. But at the end of the day, like you said, we have to, do pick assets of where we put most of our eggs into the basket. But at the same time, you want to make it sure. So if, one affects another, that you're, investing, your certain assets into different classes. So that's definitely a key point that we definitely want to get across.
Yeah, I agree, Cole.
Yeah.
And, going back to what you were saying is, understand the assets. And that goes back to what Coach TK was saying is, not only do you not want to have all your eggs in one basket and you want to be very diversified, but you also want to understand what you're investing in. And not to mention, you can prepare for a rainy day. I'm not going to personally say that a recession is on the way, but there hasn't been a crash in quite a substantial amount of time. I'm not going to say we're in a bubble either, because again, they've printed about 50%, 60, around 40 to 50% of every US dollar in the past 2 to 3 years. So we're definitely in a hyperinflation environment. You definitely need to, get the right financial education so you can prepare for said things. But, being, ready for the crashes, if there is a crash, and being diversified and not having all your eggs in one basket is something, very important that Cole just covered and Coach TK mentioned as well.
And the one thing I do want to put out there, just for everybody to know, you see a lot of things on Instagram, Facebook, TikTok, whatever it may be, of people always talking about all these different niches and aspects regarding to real estate. One of the biggest things that you got to keep in mind is if somebody is sitting here and telling you to invest into a stock, invest into a certain cryptocurrency, the things you have to look at is there limited supply? Why is this person telling me this? And then go in and do your own research. Don't go based off because of what somebody is telling you, because there's so many times where, people are saying invest in this stock and do this thing, you'll be a millionaire, ... But they have already invested in that given asset well before you have. And you know what? When it goes up, they're gonna pull out, and they're not gonna tell you when to pull out. So what I always tell people, especially if you come to Brotherhood Finance, what we say is factual education. It is not our opinion that we are displaying on you. It's things that are backed behind facts, backed behind, things that have happened in the future. As we know, history repeats itself. And we are giving you financial education for you to make those financial decisions in order to succeed and maximize your ROI.
Amen.
So,
yeah, you mentioned about, I'm thinking pump and dump as you say that. And the life insurance policy is literally the opposite of that. Life insurance policy is pump and pay. Like contract, you're putting money into it. No one's pulling the rug out from under you or getting invested in before you. You are your own contract. You did it based on your medical history, and you're using it to protect something for somebody else. Is really what you're doing. But in any case, that just came to mind as you were saying that. Again, I keep thinking with your audience, the entrepreneurial side, and then the W-2 gonna go get a job side. Brendan, you mentioned several streams of income. When you either graduate from high school or you graduate from college and you're looking up, like, where am I gonna go earn a living? Where am I gonna make my money? And you look for a job. A job is gonna give you one stream of income, and they're gonna tell you exactly how much they're gonna pay you. And that's all they're going to pay you. They're not looking to raise it. There's sometimes that it does if you're a very good employee and worker and that sort of thing. But the point is, even if you have a job and you've got that one source of income, there are other ways to create other sources of income on top of what you're already doing. And matter of fact, that's the only way to create a freedom point. If you have a job that you have to show up to every day, the only way you will create freedom for yourself is by having other sources of income along with that job. So eventually you can either do that job without having to go in, or maybe you can quit that job and move on to the next thing. But the entrepreneurial side, and then the way that you invest, whether it's life insurance or Roth or any of that stuff, those things are very critical for a W-2 employee. Because like I said earlier in the podcast, the government creates different scenarios to help out with lower income, middle income, and then the rich. The rich can kind of create their own rules. They don't have to spend money unless it has to do with their lifestyle. Therefore, they can protect that money, or they can invest that money in the tax consequences that are different for the middle class that are earning a W-2 income. So once you're under that 144,000, you need to build that good base with the Roth IRA, with the life insurance policy, with a savings plan where you create 6 months of your bills as in a savings account that is fluid and you can get to it. There's just that basic financial plan has to be your base, and then you go from there. What's odd too is back in my day, the service industry, meaning waiters, waitresses, bartenders, that sort of thing, it used to be the introductory way to get ahead because you got tips and you got cash and you could start stacking that on the side until you landed that other job or you started doing something that you could invest in yourself. And nowadays, it doesn't seem to be as common. Matter of fact, you go to restaurants now, and mostly the influence of COVID, I guess, people, they can't staff it. They can't get enough people to come be waitresses and get that cash. And that back in my day, when I was 20 years old, that was the way to get started, getting ahead. And then you had to take the cash and invest in yourself. So just a thought that I had as you guys were bringing that up.
Yeah, it's definitely crazy how, times have changed, when we, especially me, the way my parents always raised me is, yes, I feel like you can go out, get a job, do all these different things, but, I think the most benefit I've ever had is, starting my own company and doing my own thing. I think, yes, you have to have a little bit of capital to start off your company. You have to have a little bit of capital to kind of, transition and make things work. But I think it's not knowing when your, next paycheck is going to be. It's not knowing, how you do something, or, whatever it may be, that allows you to think outside the box and do things differently that nobody else does. Because, I like to think, and, I've heard this from many, many people. Once you start getting that paycheck every biweekly, or whether it's monthly, whatever it may be, you're going to be a slave to that paycheck. What you get is what you're accepting that you're worth for yourself. And especially someone that, wants to be different, somebody that wants, 10x their life and, bring a different, mindset to the game. I think, being a slave to the paycheck is one of the worst things people can do, because that's the government in a way of sucking you in to, whether it's the food industry, whether it's, the mechanic, and, just overall anything you do working in a factory. It's their way of sucking you in so that you say, well, minimum wage is $12.50. Well, I hate to tell you, Coach TK, but you're only worth $12.50, brother. So that's, for me, is one of those things where it's like,
not my lifetime, but yeah.
I know, I'm worth way more than $12.50. And, I feel like that's just a trap that everyone gets sucked in, for sure.
Yeah, 100%.
Well, that's a great, Cole. I think the other point to that is comfort level. When you start getting that paycheck, if that's comfortable to you, you won't do the things to take the chances like you and Brendan have done, to say, I'm going to go to that outside the box thinking, and be willing and having the courage to say, I'm going to do it without a guaranteed comfortable paycheck. It's that comfort that lulls you to sleep, I would say.
Yeah,
100%. And as Cole was just saying, and Coach TK mentioned, was he was saying a crazy statistic, actually, real quick before I dive into some stuff, is actually 76% of Americans live paycheck to paycheck. 56% of Americans can't cover a $500 hospital bill. So again, maybe getting life insurance, that would definitely help you out. But to cover back on what he was saying, is the problem, I feel like, is, first off, we've been in a very great economy for the last 10, 20 years. We haven't seen any, since 2008. And we haven't seen any correction. So people are really living way above their means. They're not investing. They're not using the financial education that we provide here. Or, they're just not resourcing out because they think they have time. But it's very imperative, especially now, as we just said, CPI, Consumer Price Index, inflation is at almost a 20, 30-year high. It's going to be harder for you to buy goods and services. So you need to earn your money, you need to keep your money, and then you need to multiply your money. And that's something, me and Cole really preach on. And it goes right back to, what Coach TK was saying, is you need to have multiple flows of income and passive income. Passive income is the least taxed, and earned income is the highest taxed, as Robert Kiyosaki likes to say. And that's what his rich dad taught him, was to they know debt, they know taxes, they know how to create passive income, and they know how to borrow against asset vehicles to really create generational wealth, and and a lot of those things that we just covered. So I agree 100%. People need to look at their income statement. They need to look at their expenses, and they need to, not necessarily try to look rich, but really invest in their future. And one of the ways they can do that is through life insurance, through a Roth IRA, and through some of those things that we mentioned, because the goal is not to, look that way. It's to actually have that freedom, be able to give back to your family and give back to the people you love, and positively impact as many people as possible. And that's what we try to accomplish here at Brotherhood Finance.
Cool. Hey, so another from the past type of statistic, or whatever you want to call it, from experience. The mortgage bubble that burst in 2008 actually came from the credit card bubble that was prior to that in the 90s. In the 80s and the 70s, if they even gave you credit cards, they would not give you a very big balance. Like that, it was inflated by these credit card companies being willing to lend the money because, and I don't know this for a fact, this is just my opinion or my guess, is that the government started working with the credit card companies to relieve them of situations that were bad debt, or it was too financially solvent to not give credit to people, that they gave so much credit that once we started seeing more inflation happen then that had the housing market go up, people saw that equity as a way to pay off all of this that they spent. And it was like a big piggy bank. They're taking their house, they're taking their equity, paying off their credit card debt, and then they go get a new appraisal that's a inflated appraisal to make it seem like it's worth more to then take another loan. And then when it went backwards a little bit, everyone was like, oh no, I borrowed more than what my house will appraise for. That stops everything at that point if you're using your house as that tool. And so some of the podcasts you guys have had about managing credit card debt is so huge, to not have the wrong debt, to not pay off using house, invest in assets that are going to pay you and grow. And I think those things are crucial. Those are great topics that you guys are passing on.
Yeah, and I appreciate it. And once again, Coach TK, thank you for coming on today. Thank you for really, explaining from, somebody that actually works in life insurance. And if you want to learn more about life insurance, if you want to learn more about how it works, make sure you give Coach TK a call. You will see his number down below in the description, as well as his email, and you can shoot him his email if you want to do so as well. So thank you again, Coach TK, for coming on today. Amazing points that you brought on. I'm glad you can teach our audience, a different type of investing that can create them an ROI over time. And especially is very important, not for just, when you're 40, 50 years old, but, starting in your early 20s or early 30s, for sure.
Yeah, 100%.
Thanks. Honor to be with you guys.
Yeah, thank you, Coach TK, for stopping by, really informing our audience, as Cole mentioned. And, we appreciate your time. We appreciate, impacting our audience in a great way. If you guys enjoyed up to this point, please make sure to smash that thumbs up button down below. Smashing is very important. Make sure to subscribe to our YouTube channel. Make sure to leave a comment. And again, as Cole mentioned, we'll have Coach TK's information down below, a word of wisdom, a lot of life experience, and a lot of things that he covered today that's really going to help positively impact our audience. If you might have missed some things, make sure to go back, rewatch it. Again, he spit lots of knowledge that you may have missed the first time, as it was so informal. I appreciate your time. I appreciate you guys stopping by the podcast. Check us out at Brotherhood Finance if you have not already done so.com. Check us out on YouTube, TikTok, Instagram. We're here to help you out. We want to see everybody succeed. We appreciate you. Thank you for stopping by. Have a good rest of your day. Have a good rest of your weekend. Peace out, and thank you very much, Coach TK.
Thank you.
Thanks, guys.